Okay, Jake, ready to go?
Yeah, good to go.
Well, first of all, I just want to thank everyone for coming. I appreciate the time. It's close to lunchtime, so we'll try and wrap this up within about 30 minutes, and hopefully finish by 1 o'clock. Plenty of time for lunch, us included. But anyway, look, the how we'll go through it today is to be a number of slides that both myself and Jake will run through. And basically, you're all aware what the webinar is going to be focused on. It's really about the tax savings for directors. And there's a number of methods that both myself and Jake will run through in regards to how you can take out money from a company in a more tax efficient manner. And then hopefully by the end, we'll finish with a few questions. I know we've had kind of a few that's already been submitted. So hopefully by the end of it, we'll run through a number of the questions and answers, and then we'll finish with a little bit about us in towards the end, basically. So I'll just fire away here with the speaker. So today it's obviously myself, Stephen, and we have Jake.
Hi,
I'm
folks.
one of the accountants here at Toast, and Jake is one of the trainees with a number of years of experience behind him, so a future accountant. And it's actually one of Jake's first webinars, so he might be a bit nervous, but he'll be fine. So anyway, we'll just go ahead here with a bit of an introduction. So hopefully, look, most of the people that may have joined this webinar are either current directors or maybe in the process of setting up a company or maybe becoming a director at some point in the future. And basically, this webinar is going to be focused on the ways in which you can take money from the business in a tax efficient manner. There's a lot of differences between a sole trader and a limited company and how they actually operate. But from this perspective, and more so from the perspective of taking money out of the company, one thing I would want to draw everyone's attention to is specifically that the limited company is a separate legal entity from the sole trader. And basically what that means in a nutshell, when you look at it from a bank account perspective, is that all the money that's the funds that are in the business bank account technically belong to the company. And in which case, if you're ever withdrawing money from that bank account, you need to think about, am I doing this correctly? Am I doing this, should I be doing this a different way? How can I take money basically where I can have a salary or whatever to work with at home, but also be happy that everything's covered from a HMRC perspective. You don't have any future tax liabilities to think about. So that's the main question we get asked for directors that usually start up a company is, how can I pay myself? And look, we usually find that a lot of people would ask you that question 6 months down the line or 12 months down the line, whenever they have already been using that business bank account as a personal bank account. And then you're trying to, that's when you may come into issues, but we'll run through some of those over the course of the next 30 minutes, and hopefully you have a better understanding then moving forward as to how you treat money in and out of the business bank account from your own personal perspective. So these are the methods we'll run through. First one is the salary and dividends, and then we'll have pension schemes, benefits in kind, directors' loan accounts, and the reimbursement of expenses. So the first few I'll run through with is regards to salary and dividends, and then I'll run through directors' loan accounts. Jake will then take over and run through the final three. So hopefully it will not take too long. And if there's any questions, like I said, during it, feel free to pop them in, and hopefully we'll get time to answer them during the webinar. So first of all, salary versus dividends. Now, it's probably the most common and most used method of extracting cash in a more tax efficient manner from the company. So you have a lot of flexibility of how and when you can do it, how much you can pay yourself, and it's the most tax efficient way is doing it via a small salary and then declaring the rest as a dividend. And we'll run through on the next slide what that salary actually is, but I'll just run through a couple of differences here now between the both and how they compare from an accounting perspective, but also a tax perspective. So if you look at it from a salary perspective, yes, it may be subject to income tax and national insurance contributions, depending on the amount you receive. So there is certain thresholds and stuff you need to be wary of and have a think about before income tax and national insurance actually becomes applicable. And we'll discuss that on the next slide. If you do decide to go down the salary route, then payroll is something that you will have to consider, and that you will have to operate in order to have the monthly pay slips ongoing, but then you'll also have to submit RTA submissions to HMRC on an ongoing basis. The third one then is the gross salary. And then the gross salary and employer's NIC is deductible for purposes against the company's profits. So you'll have the profits from the company, then you'll have the salary that you pay yourself from the company. The good thing is you can use that as a deduction against your corporation tax liability. So whatever salary goes through your payroll, it will be allowable. In comparison to what that is with dividends, it's not allowable for tax purposes to reduce your profits. The employer's national insurance contribution via the salary, that will arise after deducting any available employer's allowance. The employer's allowance currently is 5,000. Am I right in saying that, Jake? Yeah, for this year.
Yeah.
And basically, there's a certain threshold that if you're paying an employee over that amount, then you'll have to pay employer's national insurance. But there is a £5,000 credit that HMRC have on offer for eligible businesses that can reduce that amount you'll have to pay. And like I said, salary can be paid weekly, monthly, annually, or at any other intervals. Can be fortnightly, depending on how often you want to run it. And the last thing to be aware about, particularly as a director, if you decide to go with salary and dividends, the salary that you pay yourself via payroll will need to be declared on an income tax return. If you've got other sources of income, that is, and in which case, if you're doing a salary dividend route, you're going to have two sources of income basically. So you'll have to declare that on a personal tax return. And if you're a director already and haven't registered for self-assessment, it's probably a good idea to start or do that, because the likelihood is you will have your own personal returns to file over the years. And then if we look at it from a dividend perspective, I suppose the main benefit of dividends is that you're taxed at a lot lower rate in comparison to income tax. They have gone up recently in terms of the tax rates, but they're still a lot more tax efficient in comparison to income tax. So for a basic rate taxpayer on it, if you take it in dividends, you're taxed at 8.5%, whereas if you're an income tax, it's at 20%, and then it kind of goes up as well. So that higher rate taxpayer pays 33.75% on dividends, whereas on income tax it's at 40%. So overall, there's still a tax savings taking it via dividends, and that's kind of where you'll feel the real benefit via small salary and dividends. Also, what we find that most people aren't aware of as directors is that you're entitled to a £2,000 a year dividend annual allowance. So basically that means you can declare a £2,000 a year dividend and you won't incur any tax on it. That's each director is entitled to that. But it will still have to go on a tax return, even though you don't have to pay tax on it. And the next one, in terms of the company must ensure it has sufficient funds available to make the payment. It's very important on that. Basically, that's kind of you can't distribute a dividend unless the company has sufficient reserves in order to issue that dividend to its shareholders. And like I said, explained previously, it's not deductible for tax purposes against the company's profits in comparison to when a salary is. You won't have any employer's national insurance won't arise on the dividends. And again, a dividend can be paid annually on a more regular basis. So you can do it quarterly or annually. Again, it's when funds permit and how often you want to receive a dividend, basically. But and then we've already touched on it. The £2,000 dividend allowance dividend will have to be declared on a personal tax return. And this slide is this is the current most tax efficient salary for a director in 22-23. Now, I'm going to add on to that and kind of explain that it's probably more focused around a sole director, this salary. It's a bit different if you've got two directors, and it kind of falls in line with the employment allowance and the reasons why. So this slide is more focused on a sole director, so someone who's a director of the company and there's no other ones there. The reason why the salary of 9,100 is most tax efficient is because it's at the secondary threshold, so your company won't need to pay any employer's national insurance on it. The salary is lower than the primary threshold, so you won't need to pay any employees' national insurance, but it's above the lower earnings limit. And the reason why that's important is that you're then entitled to your state pension, so it's kind of building up the credit and makes you entitled to the state pension in later years. So it's good that you make that contribution. But also the 9,100 is less than the tax-free personal allowance threshold. So you weren't paying any income tax on that first 9,100 either. Again, the reason why I say it's for a sole director, it's because if you're a sole director, you can't claim any employment allowance. Whereas if there's two directors involved in the company, you will then become eligible to claim that employment allowance, in which case you can pay yourself a slightly higher salary, but you will have employers' national insurance to pay on it. The good thing is on that then you'll also have this credit that you're eligible to offset against that. So it's just, there's a bit more kind of things to think about, but it's slightly a higher salary for two directors. I think for this year it's 11,908, isn't it, Jake? It's close to that for
close to,
if there's more than one director involved. But there's just a few things to. Sorry, we just have a quick question, and with regards to the recording of the session. Yeah, so the session has been recorded, and it will be issued to all attendees at the end of it. So you'll get the slides and the recording of it. And so I'll go on to the next slide here. So the next couple of slides is more around directors' loan accounts, and it's probably one of the most popular things and the most kind of talked about things with directors, and particularly with accountants, in that how directors' loan accounts are used and how they're managed and what's the tax implications of them. So you'll have, there might be a situation where the company may owe money to you, right? So usually, and probably this is where you find this happening mostly, is if you're setting up a company from the start, but you're actually introducing your own personal funds in order to get it up and running. So you have a bit of money here that you've put into the business bank account in order to purchase everything you need to get it started. Basically how that would work then, and it's probably the first method that you would be looking at if you wanted to kind of start to take money from the company, is did you ever introduce money to the company? If you did, then this is the most tax efficient method, because you can just take it out and not incur any tax on it. So you're basically just taking the money that you introduced back. But bearing in mind, again, the company would have to have kind of the funds there in order for you to take it back. And, the business would still have to be able to operate. But that's the first method you would look at if you've ever introduced it. Always take it back out, because it's the most tax efficient for you. And the next one is if you owe money to the company. And this is a lot more complicated than what people may seem to believe when we started off. Now, you probably hear the phrase of an overdrawn director's loan account. And basically what this means is that from an overdrawn director's loan account is that you've basically taken money out of the company, or maybe you've used it for personal expenses and that. And it's kind of, it's like a virtual bank account, let's say, and the director's loan account, and that the transactions are kind of feeding in and out of it, depending on what you've actually used the business for. So if you've used it for anything personal, it's put into a director's loan account, and then if it's overdrawn, then at the end of the year you might have to look at, okay, there's tax implications of it being overdrawn here. And one of the first implications from a company perspective is that if it's overdrawn 9 months after the company year end, so if your year ends at December and it's still overdrawn come September time, you will have a potential tax charge on it from the company perspective. But if you do pay it back within that 9-month period, then you won't owe any tax. The other way then is to declare a dividend on it, basically. So if you have an overdrawn director's loan account at the end of the year, but then maybe there is sufficient reserves in the company in order to declare a dividend for that overdrawn amount, then basically what you do then is you declare a dividend for that amount that's been overdrawn, and then that dividend is what goes on your own personal tax return. And look, there's other situations when if a director is not able to repay the loan within 9 months of the year end, then if you're the company may elect to write off the loan. However, whatever that loan is, the tax responsibility falls on you as the director. So whatever that loan is, if it's been written off, then you must pay tax on the loan as if it were declared as a dividend through your own personal self-assessment. So using the director's loan accounts, always be mindful of what is the transaction that you're using it for. If it is personal related and it's fully personal related, it'll have to be treated as money that you owe back to the company. And as long as you stay on top of that and it's not kind of accumulating over the year to kind of a large amount, then you should be okay from a tax perspective. But the more you let it build, the more you use it for personal reasons, the more tax implications and more tax you're basically going to have to pay on it. But like I said, how to deal with an overdrawn one way is to declare a dividend on it. So as long as there's profits permitting in the company, you can declare a dividend. But you can almost guarantee that you will have tax on it. But like we touched on previously, the tax you're going to have is going to be at a much lower rate than the current income tax rates. So if your basic rate band currently is up to 50,270 currently. So if you're taking a small salary of 9,100, say, you don't pay any tax on it, but any dividend you take over the personal allowance of 12,570, you'll only be taxed at 8.5% then, as opposed to 20% if it were income tax. But that's basically how the directors' loan accounts are treated. But there's a lot of taxes to be mindful of. So if you're new to being a director and you've newly set up a company, try avoid using the bank account as if it's your own, because it's not. Basically, that's the bottom line. Is it's the company, and you as the individual are separate. And I think I'm going to pass you over to Jake now. Yeah, Jake will run through kind of the next few ones. I think we've got stuff on pensions, benefits in kind, and then the reimbursement of expenses. So over to you, Jake.
Cheers, Stephen. So often enough we would get asked, can a director contribute to their personal pension via the limited company? So a direct payment over. You definitely can. Placing money in your pension via the limited company isn't only saving money for your retirement, but it's also a tax efficient way of using profits from the business, essentially reducing the profits of the business and saving yourself corporation tax. So you can contribute into the pension without the salary restriction that all our sole traders or self-employed workers would face. You can contribute up to £40,000 tax-free per year. Any contributions above this, now keep in mind that they could be subject to a tax charge. Also, if you say had a larger amount that you wanted to contribute, you can have say £70,000 that you want to put in. If the previous year you only put in 10, using the carry forward rules, that would leave 30 from the previous year. You could now put in 70 this year. So from a tax planning perspective as well, going forward, if you expect your company to be making much higher profits in the coming years, always bear this in mind so that you can plan ahead for how much you're going to put into that pension. Yeah. The pension contributions, as I said, are classed as a business expense. So by saving on that corporation tax for every £100 you put in to your personal pension via the company, it effectively has a cost of £81 to the company. So say you put in the 40,000, that would be an overall saving of £7,600. So there's a lot to be saved there.
Yeah.
It's definitely worthwhile thinking. Now, again, it all depends if that money is available in the company to put across into your personal savings. So if the cash isn't there, obviously you don't want your reserves to fall too low. Yeah. And we'll move on to the next there, please. So benefits in kind. In addition to wages and salaries, many reward packages include other items such as the provision of cars, vans, health insurance, or even childcare. As an employer, you can choose to pay certain bills on behalf of the employee. For example, here, respective home landlines or utility bills. And these are what are referred to as benefits in kind, BIKs, or simply benefits. The charge to tax on employment income specifically includes any gratuity or other profit or incidental benefit of any kind obtained by the employee if it is money or money's worth, or anything else that constitutes an emolument of the employment. So
that's a mouthful.
That is. So essentially, it's chargeable to tax from a HMRC perspective. Now, there are other things that we'll touch on that aren't going to be chargeable to tax for the employee that goes through the payroll. And here are some examples of benefits that will have specific calculations as well. So the likes of living accommodation, cars, vans, and loans, as Stephen had previously mentioned too, your director's loan and that. Cars and vans are normally based upon the market value of the vehicle, also the engine size, stuff like that. So definitely, most recently anyway, we've been receiving a lot of questions regarding electric vehicles.
Yeah.
Now, with electric vehicles, you can charge or claim 100% through capital allowances for the company. Also, the benefit charge on an electric vehicle is 2%, so it's very, very low. Essentially, if you were to purchase a brand new electric vehicle for, say, £60,000, the benefit to the employee or yourself as director would be £1,200 for the year. So a massive tax saving there.
Yeah. We actually have another question here,
Mhm.
and it's regarding the benefits in kind side. So basically, for the benefits in kind, is the director considered an employee?
Yes, so if they are receiving benefits in kind, then this will be processed through the payroll normally.
Yeah. So it's kind of like
Um,
what we discussed earlier, and with if you're basically deciding to go down the route of a small salary and dividends, then with the salary, you'll have to operate payroll, in which case you're effectively an employee of the company at that point. And so yeah,
mhm,
answers that question.
yeah. Just a note
And
there, that last wee point there as
yep,
well. For most non-cash benefits taxable under the benefits code, there's a special class of contribution payable, and that's National Insurance Class 1A, which is only paid by the employers and not the employees. And normally, as an employer and registered for PAYE, you would complete a P11D, which would calculate how much Class 1A is due to HMRC.
yep. Okay, and next slide, Jake.
Yeah, please, yeah.
And
So
I think this is the last one anyway, reimbursement expenses, so we shouldn't take too long. We've got a couple of more questions to get through as well, so we'll rattle
mhm,
through this slide. It's pretty straightforward and
it's very
self-explanatory.
straightforward. Yeah. So just following on from the BAKs there are some benefits and reimbursement of expenses that are exempt from tax and national insurance. We have a list here. There are a lot more. So at the top there, you have your annual parties and similar annual social events. So obviously, we're coming up to Christmas here. There's going to be a few Christmas parties coming up. So you can put this through the business as an expense. That bottom note there, when an expense is reimbursed, HMRC has to be satisfied that the expense is allowable for tax purposes.
Yeah,
Otherwise, the reimbursement from your employer is treated as an additional taxable income. And
yeah.
again, a BAK, which will hit your pay, and you'll pay tax on
Yeah,
that.
I mean, suppose that just to simplify it in terms of the reimbursement of expenses. So, like, you're going to get this in times when you have the business bank account, but maybe you're out and about. You're going to a supplier. You're purchasing products from the supplier, but at that given time, you don't have the business card with you. You have your own personal card. So at that stage, you're then using your personal card to buy the product. And what reimbursement of expenses and a way of it is that yeah, technically it's a legitimate allowable expense for the business. You pay for it personally, therefore you're owed that money back
Mhm.
from the company. So basically, what at that point, then you put the expense through the company, and then the company then will just repay you back for that expense. So that's kind of what the reimbursement of expenses covers as well, because it does happen. It's unavoidable at times, and that you're using your own personal card when you're out and about to fund business expenses. So it
Mhm.
does happen, but just bear in mind that you will be entitled to that back from the company. And I think we have potentially another question here. What if the company has more than one director? Um, so again, I think you mean from I think they mean from a perspective of the salary and dividends aspect. So we did touch on it a bit earlier, in that if there's more than one director involved, then the salary can be adjusted a bit differently, but it still works out more tax efficient. The big thing is that you have the employer's allowance that you can claim when there's two directors involved. But ultimately, the dividends is going to come down to the shareholding in the company. So if you've got two directors here and you're both 50-50 shareholders, then when it comes to dividends, it's kind of okay, if you're declaring dividend for one, you have to declare dividend for the other in line with their shareholding. You can have occasions when perhaps, look, one director has the is entitled to waive their right to receive the dividend. But what that basically means is that, okay, one shareholder gets their 50%, the other shareholder's like, no, I want to keep my money in the company, I don't want to declare it yet. For all the reasons, they might have other sources of income, and basically they'll have a higher tax bill if they do withdraw the dividends. So they can elect to actually waive their right to that dividend. But what waiving the right, it doesn't mean then that that other shareholder can declare their share of the 50%. It basically means that if you're waiving your right, the 50% sits in the company still, but the other director still takes their 50%. Again, it all comes down to whether or not the funds are permitting within the company. But yeah, hopefully that answers that question. We have a couple of other ones here, and I think one's pretty relevant because I think there's only been a change recently. But it's with the addition of the 1.25% now remaining on dividends, but reversed on the salary. Is it still better to take dividends? Yes, from overall tax perspective, yes. I get what you're coming from on national insurance, and that they had increased it from April to 13.25%, I think it was. But then they've now pulled back on that, and it's now dropped again to 12%. The reason why it's still more tax efficient to take dividends is because you're still going to be, well, if you do a small salary dividends, the salary is still going to be at a level where you're not going to incur any national insurance contributions on it anyway, because it's below the thresholds. So yeah, it's still going to be more tax efficient for a small salary and dividends. But I just want to kind of end on the salary and dividend side by saying that it really depends on if you've other sources of income. If you've no other sources of income, this is the only source you have in the business. Small salary of 9,100, the rest in dividends is tax efficient from a sole director perspective. But if you've got other sources of income outside the company, then obviously that wouldn't be beneficial because your personal allowance is potentially being eaten up elsewhere with other sources of income. So it can be very case specific, but if we're assuming here that there's no other income involved when it comes to the salary and dividend perspective. And a final two questions, because I'm wary of the time. Is it worth taking money from the business account and putting it into savings, or does the tax to be paid negate the benefits? The question.
I'll take that
Jake,
one. No worries. Well, it really depends. If you mean transferring to a business savings account, then the funds essentially remain in the company as an asset, and the interest earned on that will be liable to corporation tax, as it is another form of revenue for the company. If you mean transfer to your personal savings account, then this transfer really will be allocated as a dividend or a transfer to director. In most cases, you would probably say that this is a dividend. Now, the interest earned by yourself personally, that'll then need to be included in your personal tax return. Now, obviously, you will have the savings allowance. So if you're a standard rated payer of tax, you'll get the £1,000 saving allowance. If you're a higher rate, you'll pay, or you have your £500 saving allowance. And if you're an additional rate, you'll have no allowance. And it's quite similar to the dividend allowance, where you do have to declare it, but it'll be taxed at 0%.
Good stuff. Two more questions and then we'll finish it up, folks. With regards to the tax, so your example of most tax efficient of 9,100 per annum, is this amount for each director? Or is this the amount for the company, meaning this amount is to be divided by two directors? No, yeah, that'll be on a per director basis. Now that 9,100, like I said, is based on a sole director. So that's kind of okay. If it's just you're the only director and shareholder of the company, 9,100 is the most tax efficient. If there's two directors involved here, then it'll be each 11,908, I believe. But you will have a slight employer's allowance to think about, but you'll get that credit because you'll be eligible for that employment allowance credit. So that's on a per director basis. So yeah, it's not 9,100 split between yourself and the other director. And then last question. How will I know how much dividends I can take from my company? Jake, you want to take that one? And we'll wrap it
Sure.
up.
Yeah, no worries. So that figure again is dependent on the reserves of the company, whether the cash is available. They pay it out at a certain point in time. That's why really we keep our clients' records and accounts up to date, just so we know at that certain point in time where are the reserves at, is the cash
Yeah.
available.
Can you
Um,
declare a dividend basically?
exactly. It's
And
fully
that's
dependent on
yeah.
that.
And look, I suppose it's a good place for us to finish now, and just a bit about us. So, for those of you that don't know what TOAST stands for, it's not breakfast related. It actually stands for Totally Online Accountancy Services and Taxation. And basically, what we kind of rely on the fully remote aspect and kind of the cloud accounting services so that everything is online. And the benefit of those is, and the kind of the more advisory aspect is where we find it most beneficial for our clients, and that we're able to tell, okay, can you declare dividends? How much dividends can you declare at any given point? Rather than waiting to hear from your accountant once a year, you don't know how the business is performing, and then you're kind of finding out, okay, this is a dividend you can declare, 12 months after the fact. Whereas if you know on an ongoing basis, there's sufficient reserves there, you can declare it as a dividend, and that's kind of the main benefit you're going to find from it. So yeah, just a little bit about us, what the services we provide, and kind of why you choose us, kind of thing. If you're ever looking at switching, or you ever need an accountant, our contact details will be on these slides anyway, that will be issued to all the attendees and the recordings. And if there's any questions we didn't get through, then look, we'll be sure to respond to them via email, and we're happy to help on that way. So I just want to thank everyone for joining.
Thank
Basically,
you very much,
hope I
folks.
didn't take up too much of your time, but hopefully it was beneficial and you took something from it. But like I said, the recording and the slides will be issued to everyone registered. So all good. Have a good day, folks.
All the
And
best.
all right, see ya.
Bye.